Good morning, everyone. My name is Michael Wexler. I'm a research scholar here at the Digital Financial Services Observatory, a project of the Columbia Institute for Teleinformation at Columbia Business School in New York City. I'd like to welcome you all to today's DFS Observatory webinar, Opportunities to Expand Financial Inclusion Through Digital Technology, being presented by Dr. Leora Klapper of the World Bank. Just a couple of housekeeping notes. Please switch off your microphone and your video, and please do not ask any questions via the audio at any time. We'd like you not to interrupt the presenter, and send your questions via text to the host, who is Jason Buckweitz, via the chat box. We'll get to your questions at the end of the presentation. Today's agenda will be a 1-hour webinar. The 5-minute DFSO introduction is being given by me, followed by a 45-minute webinar to be followed by 10 minutes of written Q&A via the chat box that I had mentioned. Again, please only send your questions via the chat box. I'd like to introduce you to our DFSO webinar team. That's me, Michael Wexler, and we are broadcasting to you live right from the Columbia University campus in Uris Hall, right where that arrow is pointing, and this is the rest of our team. Our website can be found at dfsobservatory.com, where you can find a wealth of DFS and financial inclusion related resources. DFSO activities include the maintenance of the legal and regulatory database on DFS I just mentioned, model laws and regulations, the production of webinars, roundtables, and our annual summit, commentaries and analyses of new laws and regulations, and we work in close collaboration with industry, regulators, academics, donors, and standard-setting bodies around the world. This is a screenshot of our DFSO calendar on our website, which allows you to be apprised of our upcoming events, such as webinars, our Blockchain and Global Crypto Economy Conference on November 22nd, as well as our annual summit to take place on February 7th in 2020. So now I'd like to turn to the main part of our webinar. We're honored to have Dr. Leora Klapper present to us today. Leora is a lead economist in the finance and private sector research team of the Development Research Group at the World Bank. Her publications focus on corporate and household finance, banking, entrepreneurship, and risk management. Her current research studies the impact of digital financial services, especially for women. She's a founder of the Global Findex database, which measures how adults around the world save, borrow, and make payments and manage risk. Previously, she worked at the Board of Governors of the Federal Reserve System and Salomon Barney, and she holds a Ph.D. in financial economics from the New York University Stern School of Business. And now it's my pleasure to turn the microphone over to Dr. Klapper.
Thank you, and thank you to everyone for your patience with the technical difficulties. I'm excited to have the opportunity to talk to you, and very much welcome your comments at the end or by direct message. So jumping right in, first, what is financial inclusion? Simple definition, it means that households, individuals, all individuals within a household have access to and can effectively use appropriate financial services. These services should be provided responsibly, sustainably, in a well-regulated environment. So it's a very high-level definition. Effectively, it means, do people have bank accounts? Do people have a safe place to save, ability to build a credit rating, credit history for appropriate credit? So why does financial inclusion matter? Three things we highlight. First, by increasing income, it helps poor people climb out of poverty by making it possible to save, to borrow, to invest in educational and business opportunities, for small enterprises to pursue promising growth opportunities. Second, by increasing resilience, it provides a way to survive economic disasters like unemployment, droughts, floods, loss of your breadwinner. Financial inclusion also prevents people from falling into poverty in the first place. In America, you have over 100 million adults who are borrowing, often for medical reasons, except who have borrowed for medical purposes. Even in high-income countries, having savings in the bank, a safe place to save, can help people from missing that next rent check, from falling into poverty. And third, for regulators, especially, a goal is to increase transparency. Digital payments to businesses, employers, and family friends are more traceable. So, for example, this picture comes from a recent compendium we did showing how digital financial services can help us, enable us to reach all of the sustainable development goals. We like to say that having a bank account, access to financial services, is not the end goal, but it's a means to an end. It's a means to, for example, in Kenya, there's a study showing that setting up accounts for rural farmers in India, this is a recent study showing that setting up accounts for rural farmers reduced the rate of rural poverty between 14 and 17 percentage points. In Kenya, recent study showed that mobile phones, access to mobile money accounts, have lifted Kenyans out of poverty, especially women-headed households. So that addresses the question. It's SDG number 1, reducing poverty, increasing decent work, economic growth, SDG number 8. In Niger, distributing government social benefits digitally via mobile phone instead of through cash has cut administrative costs by a fifth and reduced ghost payments and corruption, another SDG goal. This final bullet here, another study. There's numerous studies that have shown that offering women their own bank account, a safe place to keep their money, increases household spending on nutritious food and education, on health care. For example, a recent paper shows that when women in India received accounts linked to a job guarantee program, which provided a subsidy, they increased their labor force participation and earnings compared to a woman who received the money in cash. Having an account, access to digital payments, can increase privacy, security, and control over the money, which, as we'll talk about further in the presentation, can especially help women. So we're going to get into a lot of numbers, but I'm going to give you context behind the numbers, and also how the numbers that we collect, the data we collect, can help us design policies, design products, financial products, to deliver financial services, especially to poor adults, rural adults, and women. So in 2010, with funding from the Bill and Melinda Gates Foundation, we started collecting, quite ambitiously, data on financial inclusion. At the time, we were interested in the simple headline numbers on how many people around the world have a bank account. We didn't know. We had some surveys, for example, FinScope that was done in Africa, some African countries, but we didn't have global numbers. And so we partnered with Gallup, who conducts the Gallup World Poll, a survey that interviews over 150,000 adults over the calendar year, up to 150 countries, and we added on a module to collect this data. So what is the value of the data? Again, we want to understand how people use financial services around the world. Importantly, both use of formal and informal services. We also want to know the gaps, who's being left behind, is it women, is it poor adults, rural residents. The data can be used to track global policies and examine the relationship between financial inclusion and other outcomes. And it very much complements supply-side data. That's data. I'm sorry, could someone please mute Neko? Thank you. It complements the data collected directly by regulators from banks around the world. So this is a photo of me for those of you that I haven't yet met. And this was, we've also had the opportunity to pilot the questionnaire with Gallup around the world, where we sit in people's homes, run through the questionnaire, which is really important for us to make sure the value of the data is people's understanding of the questions, that people understand the questions, and to get context and ask people, why did you make the financial decisions you make, which often seem irrational for us sitting in Washington, D.C., but make a lot of sense for people in developing countries. So, for example, this is a photo here in Kenya. The man we were speaking to said he was a dreadlock designer who was very proud. He just opened his first, he rented his own storefront. I was telling us how, he was providing his dreadlock designs and being paid in cash, and he kept saying, but the cash burned my pocket. But then people started paying him to his M-Pesa mobile money account. And he's like, and I didn't cash it out. He kept his money on the phone until he had enough money for a down payment on that storefront. And these are the stories, that explain why payment products, why digital financial services have these tremendous real effects on the livelihood and welfare of adults around the world. So here's our map of the world. As I mentioned, we started collecting the data in 2011. We have data, it's collected triannually. So we now have data for 2011, 14, and 17. We're very excited to go out in the field in 2020 to collect the next round of data with lots of new questions around digital payments. And as I like to say, we're asking now about products that hadn't yet been dreamed up. When we drafted the first questionnaire in 2010, including, for example, on ride sharing. So since 2011, about 1.2 billion adults have gotten an account, including about over 500 million adults since 2014. Today, about almost 70% of adults around the world have an account. And the map's gotten a lot darker. We see in West Africa as mobile money accounts have expanded from East Africa to West Africa and beyond. We see the darkening of the map in Central Asia as governments have digitized their own payments, providing accounts to many adults. We see Indonesia, where now over half of all adults have an account. And then the literal huge caveat is India. India opened over 300 million new accounts. And again, all of these, as I should have mentioned, these are all leveraging new technology, leveraging the mobile phone to deliver the mobile money accounts. And in India, leveraging biometric identification, which allowed the government to offer JDY, no-fee simple accounts, literally winning the Guinness Book of World Records for opening the most accounts in 1 month. India was successful in expanding account ownership virtually throughout the country, to poor adults, to women, but with a very important caveat that as of 2017, almost half of all accounts in India were inactive, using our definition of not having a single deposit or withdrawal in the last calendar year. And so we really, policymakers, practitioners, see this potentially as the world's largest financial inclusion opportunity. How can we get people who are now empowered, who have an account, to use it? And that's what we're going to shed some light on. So this is the map of sub-Saharan Africa in 2014, 2017, showing the massive expansion of mobile money accounts. These are accounts provided by telecoms that are accessed via text-based simple phones. And ownership has risen from 12% to 21%, plays an important role, especially in some fragile, conflict-affected economies, where it's especially dangerous, costly to send money even within the country. It allows, for example, children working in the city to safely and less expensively send money back home. As you can see, in 2017, the map again has darkened a lot, especially in West Africa. In 2015, we went to Ghana to talk to pilot the questionnaire. I was especially interested in the question why so many women who had bank accounts were telling us they were only saving using susus. This is an informal money collector who comes on a moped every day, collecting $1 from a woman and giving it back to her less a day saving at the end of the month. In other words, women are paying to save. And when I sat in their homes and asked them, they explained to me that they had end-of-month expenses. They need to pay the school fees, the electric bill. They literally couldn't save $1 in their home overnight without the money being borrowed or stolen from a family member or someone else. And that it just didn't make sense to every day take a bus across town and wait online to deposit that $1 in a bank. That the banks just weren't designed for these low-denomination, high-frequency payments. However, and that was in 2015, 2017, when we looked at the data, we saw this big shift that women were now both using mobile money accounts and shifting some of their savings to the formal sector. In other words, it's easier for a woman to go next door to that agent on her block and deposit $1 a day every day, right, with very low transaction fees, no cost in the deposit, rather than a bank. And that's the gap that mobile money is filling on the continent. And again, the big caveat, two countries that really stand out in sub-Saharan Africa in our map are Nigeria and Ethiopia, where we did not see any growth in mobile money, and two countries that, at least in 2017, did not have a regulatory environment conducive to mobile money, and we look forward to seeing the data in 2020. So as I mentioned earlier, what's critically important about our data is its ability to disaggregate the data by individuals. That's not enough to ask, does a household have an account? We're interested in whether each person within the household has an account. younger adults, women, and older adults as well. And so this is just a snapshot. We're very excited. The data, the headline indicator is now included as SDG goal target 8.10. And here are some summary statistics. And really what stands out is you're able to really identify who is the unbanked. So, for example, looking at age in Southeast Asia, especially, for example, in Myanmar, there's younger adults are 20 percentage points less likely than older adults to have an account. We also look at by education. In Cambodia, for example, the less educated adults with only a primary education are 34 percentage points less likely than more educated adults to have an account. This is a trend throughout Southeast Asia, and East Asia, and it really highlights the policymakers that when designing new accounts, the remaining unbanked are less educated, might be less literate, less numerate, and making sure that the product is designed to protect the consumers who will be using it. We look at the gender gap, which we'll dig into. In both Bangladesh and Pakistan, men are almost 30 percentage points more likely than women to have an account. And then the income gap, and what's notable is, for example, in East Asia, which is virtually many countries has no gender gap, we do see big income gaps. In the Philippines, for example, wealthy adults are almost 30 percentage points more likely than poor adults to have an account. And this is, again, the power of the demand-side data, of being able to ask adults, understanding very often the supply-side data collected by regulators is somewhat of a black box. We can't really unpack it. And so by going out and asking adults about their financial usage, we're able to better target products and policies. Okay, and I just wanted to sneak in one slide on the G7 countries to also remind you that we have the data for over 145 countries, including high-income countries. And so in the United States, for example, wonderful surveys, demand-side surveys from the FDIC, have shown us for many years the income gap in the U.S. Here we find about 13% that wealthy adults, those adults living in the wealthiest 60% of households in the U.S., are about 13 percentage points more likely than those in poorer households to have an account. But what should be notable about this slide is that we don't find that in other G7 countries, and this gap is correlated with Gini coefficients and other measures of inequality. So looking a little bit more carefully at the gender gap, in developing economies and the gender gap has been stuck at about 9 percentage points since 2011. There's been, we could say, proportional growth on the global level, but it really masks some bigger regional and country gaps. So there's some economies that have seen inclusive growth. India, I mentioned, slashed their gender gap from 20 percentage points to 6 percentage points with this massive campaign to open accounts. Although I will note that there is a bigger gender gap in inactive accounts. Women are less likely than men to have almost about 12 percentage points less likely than men to have an inactive account. In Indonesia, women are actually 5 percentage points more likely than men to have an account, and they have never seen a gender gap. However, Turkey, where women are 30 percentage points less likely than men to have an account, and we've seen a number of countries that have had where policies to expand financial inclusion have been successful, but only for men, and we've seen a growing gap. In Bangladesh, 65% of men have an account, compared to only about 36% of women. And we'll dig in a little bit about what's behind these gender gaps. Turkey, for example, which has one of the lowest rates of female labor force participation. Women have fewer assets. In West African countries where we see large gaps, such as Togo, are also countries where women are less likely than men to have a national ID. And also, let's get to the next slide. So 1.6 billion adults remain unbanked. So who are they? We've made tremendous progress. Looking at the numbers, it's a little bit of a number game. China and India still have the largest percent of the unbanked. Indonesia, Mexico, Nigeria, where mobile money has not offered the opportunities it has to other countries in the region. And of the unbanked, again, we're able to see who are they. So the majority are women. In some countries, especially North Africa, some South Asian countries, it's a bigger percentage are women. Most are poorer adults. In China, 65% of the unbanked live in poorer households. Again, important to note that majority have a primary education or less. This is important for consumer protection frameworks and designing products that make the poor adults and less educated adults less vulnerable. And it's important, I think, to put in bold that about half are out of the labor force. This is getting hard, right? It's a lot harder to figure out how to make commercially viable financial products to people who don't have regular income, but yet potentially have a great need for financial services. So why do people go without accounts? And so we have a question we ask an unbanked: why don't you have an account? So importantly, you're able to answer multiple answers. On average, people give two answers. They say, I don't have enough money, and so I think it's important, that caveat, right? So only about 20% say money's the only reason. If you say, I don't have enough money and the account's too expensive, well, maybe you'd be able to afford the account if it was cheaper. And there's also an important question that we can show that only about 3% of unbanked adults say the only reason I don't have an account is I just don't need it. That's a very small percentage and suggesting a tremendous untapped need for financial services. So the other reasons, about a quarter of all unbanked adults say accounts are just too expensive. In Latin America, which is a relatively less competitive, more concentrated banking system, about half of adults say cost is a barrier. About a quarter of adults report banks as being too far away. And it's really nice to note that about 60% of those who say the bank's too far away have a mobile phone. Again, how can we leverage technology, mobile agents, and local financial services? About 20% say they don't have the right documents. A quarter of unbanked adults in sub-Saharan Africa report documentation as a barrier. And this is especially potentially harmful for women, challenge for women. About 15% say they don't trust banks. This, again, is a lot harder. Interestingly, it's both it's almost 30% of unbanked adults in the ECA region, which has historical legacy of banking crises, but as well as it's almost 30% of unbanked in Latin America, where the bank fees are really high. So how do we build greater trust? By making the services more affordable, more fair, and more potentially in a stronger consumer protection framework. And about a quarter of unbanked adults say they use somebody else's account. In Turkey, where we have that 30 percentage point gender gap, women are likely to say, I don't have my own account, I just use someone else's. So how can we expand financial inclusion to all? So advances in fintech, we believe, hold the key. Developing economies, over 65% of the unbanked, a billion unbanked, have a mobile phone. Now here's where I wanted to pause for a moment. The one piece I didn't mention about the gender gap, which I want to talk about now, is digital exclusion and the digital divide. And the importance of making sure is, Bangladesh, for example, where mobile money accounts surged by about 30 percentage points for men, but only by a few percentage points for women. Part of the story is that women are being left behind at the starting gate because they don't have access to the technology. They don't have access to the phones. They're not comfortable using primarily male mobile agents. And this is a story in other countries as well. And so we find we have very nice new questions on phone ownership, personal phone ownership, usage of the internet. I have a blog on Brookings from a few months ago on using this data. So globally, we find about 80% of adults have their own, developing countries have their own phone, 93% in China, about 70% in India, but then we find a 10 percentage point gender gap between men and women, and in some countries it's much larger. So here's just a picture where the blue bar is personal phone ownership for women, and then if you extend it through the gray bar, that's for men. And we see, for example, in Pakistan, a 60 percentage point gender gap between phone ownership between men and women, in India and Ethiopia, Bangladesh, Vietnam, and this is important not only clearly for the delivery of financial services, but for increasingly the delivery of many other social and professional services to women. And so, for example, in Nigeria, in Nigeria, 86% of men have a national ID compared to only 72% of women. Okay, so why do we care about digital payments? And I apologize we started late, so I'll go through this very quickly. But digital payments is far more than a convenience. As I mentioned, the example from Niger earlier, and we have examples from Mexico, it reduces opportunities for corruption in public administration, means poor adults don't have to spend time and money, monetize bus fare, their time traveling to collect social safety payments. They're safer, to travel using cash. And there's research in Kenya, for example, showing that people with mobile money accounts, when they're in trouble, they get money from a wider, both geographic but also social network of friends. I'll tell the story of we were piloting in Zambia. A school teacher told us how she was complaining the first of the month she needs to close the schools to travel to the city to collect her payments. And she was complaining about the safety of traveling by bus with a wad of cash in her pocket. But imagine if they digitized that payment to her. So not only would it be safer for her, more convenient for her not to have to travel, there's also a potential reduction in leakage of that money from the government's perspective. And the ultimate goal, potentially, is the schools can be open an extra day or two a month, right? So this can have an impact on many of the SDG goals that we all care about. So where's our data? We've seen digital payments increasing in developing economies from about 67% in 2014 to over 75% in 2017. Developing economies, we see that of account holders, about 70% of account holders are now making or receiving a digital payment from their account. In some economies, we've seen really a surge. In China, which is the WePay, Alipay phenomena, as in Thailand, for example, where the massive increase in digitized payments from the government to utility companies, et cetera, which we'll dig into. So what are some examples of digital payments? Well, we have debit cards. This might, whether or not this is a legacy product we could discuss. But I just want to point out two interesting examples. India. In India, where we have this enormous inactivity, dormant account rate, almost half of accounts are inactive, we see actually very low ownership of debit cards and even lower usage of those cards, which means that if you want to use your card, you need to travel to the bank to stand online, which is difficult, again, especially for women who may have more household responsibilities. And so that's an example where, if not debit card, because this greater ability to make or receive payments using agents and or cards could increase usage of accounts. Also Kenya, which has really low debit cards, but that's not surprising. Let's go, well, you have to wait 2 slides. First, credit cards we also ask about. Here the story is simply that the usage in developing countries is still very low. Although it is interesting to note in higher income countries, middle income countries, that most people who have a credit card do use it. Very low inactivity rates, and this year we'll be asking additional questions on to try to disentangle whether a credit card is used more as a payment instrument or as a credit instrument. And so going back to Kenya, the story I was telling, we also collect detailed questions. The database also includes detailed data on the use of mobile phones or the internet to make payments. This is potentially a less expensive, more convenient way to make or receive money. Importantly, I think, the data is available disaggregated, but we're showing here being a little agnostic about whether the payment is coming from a mobile money account, an M-Pesa, Bcash type account, or from a bank app, WePay, Alipay app. It's just really leveraging the mode of payment, leveraging the convenience of the phone. So globally, about a quarter of adults report making a payment from their account using a phone or the internet. It's about 55% of adult account owners in high-income countries, compared to about 1 in 5 in developing economies. In China, over half of account owners are using a phone to make a transaction. And here, so looking at Kenya here, the reason people don't use debit cards is they have, in their situation, perhaps a better alternative. We see over 80% of adults making or receive a digital payment using their phone. So the point here is just that there's variation in how digital payments are made around the world, but the trend certainly is that they are increasing. we had new questions in 2017 on online shopping. In 2014, for the first time, we asked the question, did you buy anything using online? And I got really excited that this was a measurement of online shopping. And then we went to Vietnam, and we're talking to people, and I said, well, how do you pay for that online purchase? Expecting them to say, a card, and they said, oh, we pay in cash. And so we added in 2017 a very important follow-up question on how do you make your payment? And so if you look at the bottom bar on the figure on the right, in Vietnam, for example, although about 20% of adults buy stuff online, trivial, about 2-3% of all adults are actually paying for that online. The rest are paying cash on delivery. And this isn't trivial. We were in India this summer, and I was talking to a shopkeeper who had a small shop but had a big shop on Amazon, where she said most of her sales were now coming from. And she was complaining that because she was paid cash on delivery, her inventory was being held up. If she sells something on Monday, she may not receive the cash until Friday, when that money is finally when the product is delivered and the cash is received. And so this is slowing down small businesses' ability to restock their inventory and grow their businesses. And so this is really a tremendous opportunity. China, where Alipay, WeChat were designed for online payments. About 85% of online shoppers paid online, but on average, only 7% of adults in developing economies do so. Lebanon, Vietnam, more than 80% of adults who bought something online paid cash on delivery. And again, this is a tremendous opportunity. It's building trust on both the sides of the buyer and seller that the good will be received, that the payment will be made, that can have a really significant impact on economic growth. So what else? We collect data on domestic remittances. This is really important in many countries, such as Africa, also in East Asia, Philippines, Indonesia, where family members are living in other parts of the country. Historically, it sent money either in cash or in other unsafe ways. About a quarter, even in between cash and digital payment would be, for example, the money Western Union type services. But the difference is that if you send money by Western Union, your mother has to take the money home in cash. Whereas if the money is sent, for example, into a Bcash account, there's the opportunity to keep the money electronic and to keep the money safer from both more secure, resisting temptation, which we're seeing people beginning to do, which is why it's important to develop more formal remittance channels, both domestic and international. Unfortunately, although international remittances are a larger volume, the number of people is relatively small, and we don't have the power in our data to ask on that. But we do ask on domestic remittances, which, as you can see on the right, is very high in sub-Saharan Africa. In many countries, over half of all adults report sending or receiving a domestic remittance payment, and it makes it easier and cheaper to move the money around. And another example, like in India this summer, we were speaking with farmers, and we met this woman who told us that every month she spends 50 rupees taking the bus to the city to pay a 250 rupee electric bill. And that just doesn't make sense, right? And so here are some examples also of the costs of the bus ride, and again, monetizing the lost garnished wages from spending the time traveling to transfer money. Having better especially mobile money, can fill that gap. Also, government payments. We asked a question on, do you receive a government transfer payment? How do you do so? Brazil, South Africa, two countries that committed to digitizing the government payments. We see 80% of recipients saying they receive the payments into an account. Although there are many countries, in Philippines, where account ownership has been stuck in the low 30s. Only about 33% of adults have an account in the Philippines. It's an example, if you look on the right, that orange piece of the bar right across, those are people who are receiving their government transfer payments in cash only. And so, I'm sorry, did I lose my... here we show a heat map where the size of the bubble are adults who are unbanked and receive a government payment in cash. So the size of the dot suggests how big the opportunity is. So, for example, this is showing that there are globally 100 million unbanked adults who receive government payments in cash, nearly 70% of whom have their own mobile phone. Again, suggesting that there are ways, ways to leverage technology, opportunities to leverage technology to deliver these payments, which could reduce leakage on the side of the government, as well as improve the welfare of the recipients. Here are some specific examples. So, for example, in the Philippines, over 7 million unbanked adults receive government payments in cash. Ethiopia, 3 million unbanked adults. We also ask questions about how do you receive your private wage payments, as well as government wage payments. Here's an example of a study I've been working on in Bangladesh, where we are studying the impact of paying garment workers directly into the bank account as opposed to in cash. We find our inline has found the savings almost doubled for women, mostly women workers. Savings almost doubled for workers who are paid into an account as opposed to in cash, partly because reduction in impulse purchases, reduction in purchases of gold, and more control over how the money is spent. We also find that they're less likely to suffer from end-of-month shocks, suggesting they have more control over the money. We met a woman who told us, "My mother-in-law waited outside the gate for me on payday. Now she can't." So these women are having greater privacy, security, and control over their money. And so where are the opportunities? There are about 200 million unbanked adults paid private wages in cash. Indonesia, almost 30 million unbanked adults are paid in cash. It's also important to note, certainly not all workers are working within value chains, but increasingly the large global value chains, Levi's, The Gap, and others, are encouraging, if not requiring, their suppliers to pay their workers in cash. It creates an electronic trail of wages, and it's better for the workers. In Bangladesh, we met factories who were, they were paying millions of U.S. dollars in small denominations on payday. They literally had to close their production, their factories for days to dole out the cash. And so digitizing the wages of their workers would have a tremendous impact on their bottom line. And so really it saves money for the employer and their welfare benefits for the employees. And so here are some examples. In Mexico and Nigeria, where you have over 5 million unbanked adults paid their private wages in cash. And finally, we look also at how do you receive your payments for the sale of agricultural products. Here, too, increasingly think of global value chains and the agribusiness chains, coffee, tea, cocoa throughout Africa and Asia. And farmers are perhaps the people most in need of these financial services. They receive a lumpy income. They may only receive money seasonally, and they have to stretch that money to the next harvest. They need to pay their monthly school fees and rent, and still have money left over to buy their next round of seeds, of fertilizer, also cross-selling appropriate credit, insurance products, etc. And so it's actually, so we see about over 230 million unbanked adults receiving agricultural payments in cash, especially in Africa and Asia. And Vietnam, for example, 10 million unbanked adults receiving these payments in cash. Nigeria, again, where there are a number of large value chain farmers, over 20 million unbanked adults receiving their payments in cash. And then looking at India for a second is slightly different. Here we can look at the opportunities of all these hundreds of millions of adults with inactive accounts. There are over 200 million banked adults. I'm sorry. This is bring a slide. I'm sorry, the slide's out of order. But there are tremendous opportunities to pay unbanked banked farmers as well. I apologize. This is a slide. I'm sorry, that's correct. So India, over 200 million banked adults who are paying, who receive agricultural payments in cash. Okay, so let's talk for a second about savings. I referred to earlier the story in Ghana, where we have this very high use of semi-formal savings products in Africa. So these are susus, money collectors. This is also various merry-go-round, rotating savings, community savings groups. Again, these are women and men, who are able and willing to save, but doing so in less safe ways, so in ways that aren't helping them build credit history to access appropriate credit. And so in Africa especially, there are tremendous opportunities. If we could maintain the social networks of the informal savings groups to keep their money in a safer place, a mobile money account using a mobile agent or a bank agent, it can have both increase the number of banked adults as well as help these adults have a formal foothold into the formal financial sector. So, for example, there are 9 million unbanked women in Pakistan who are saving using informal savings groups, about a quarter of all unbanked women in Indonesia, about 35 million unbanked women across sub-Saharan Africa. Finally, utility bills. And so this is, again, far more than a convenience. When there are a number of successful pay-as-you-go models throughout Africa and elsewhere, where adults pay in advance for their utilities. This encourages utility companies to invest. We know that online payments is related to on-time payments. And we see, and it's also simply the time savings, again, of having to, again, Bangladesh, we talk to workers who on the first of every month garnish their wages to take off, to run around town paying their various bills. The factories are losing profits, they're losing production time, and the workers are losing their wages. And so just between India and China alone, we have over 500 million adults who are banked, who have an account, but are making their utility payments in cash. And so here are some examples of where the light blue is those who are paying their wages, their electric bills in cash. So key takeaways: financial inclusion is on the rise globally. We're increasingly leveraging new technologies such as phones and the internet. However, really important gaps remain, especially women and poor adults are less likely to have an account and also less likely, in many cases, have access to the technology being used to leverage the expansion of account ownership. But finally, advances in digital financial services, digital payments, savings, credit, insurance products delivered through digital platforms. Also, again, to highlight, supported by the appropriate regulatory and supervisory environment, are key to achieving inclusive financial inclusion. Please visit our website. We have all the data. All 150,000 observations are available, both microdata and country statistics, including a number of reports. All of our figures in our reports are available, as well as we now have a new Sub-Saharan Africa series of notes digging deeper into a number of issues, including the challenges for women, ID ownership, and youth. So thank you, and I welcome your questions and hope the data is useful.
Dr. Klapper, thank you very much for your comprehensive presentation. We've now arrived at the questions and answers portion of our webinar, and I'm happy to report that Dr. Leon Perlman, head of the DFSO and the usual host of our webinars, has been able to join us remotely and has sent in today's first question. Although people sign up for mobile money accounts, they are often dormant and the accounts are primarily used for cash out. What are the reasons for this low usage, and how can it be improved?
Thank you. So I probably have exhausted everyone on the phone with these numbers, so take a breath. Yes, and so the numbers he's referring to is in many of the markets, you find that people sign up for an account, maybe use it once, and then it becomes inactive. So the question is, like any other financial product, how do we keep people engaged in using the accounts? And the solution, I believe, is just designing the right products. People in Africa, as I used the term earlier, these low denomination, high frequency payments, right? So you can think about women wanting to save $1 a day, people who want to buy very small denominations in the market, they're buying food. What kind of financial transactions are low-income adults making, and how can we design the products that how can we convince them that making a payment digitally is safer and more convenient than making it in cash. But that's also, there are larger challenges of building trust in the system as well, right? That need to be addressed. But I get back to the convenience and affordability, making sure the agent networks are there to support convenient and affordable cash in and cash out. But if I can plug, we have a new paper on digital payments and informality, which addresses a number of these challenges.
Yes, you can plug, and please feel free to do so.
Thank you.
Our next question comes from Abdul in Kampala. Thank you, Abdul. His question is about giving people increasing amounts of credit via their mobile money accounts who may not be able to eventually pay back loans that are given to them via mobile money. They are then placed on a credit blacklist. Can this provision of credit lead to increasing financial exclusion rather than financial inclusion?
Yes. And there is need for a stronger consumer protection framework around digital credit and how that money is both borrowers are solicited via digital means. And there's some very good recent work by CGAP, a part of the World Bank, who I recommend reading.
So I have a more open-ended question from Salim in Jakarta. Salim asks, despite having bank accounts, most of the bank do not use them because cost and inappropriate services. The research has found that the unbanked keeping to themselves and the use of cash creates anonymity and makes them invisible to formal financial institutions who prefer identity over anonymity. If I can summarize Stephen's question as being this: are the financial inclusion numbers skewed if people have bank accounts but just don't use them because of cost and not wanting to be tracked?
No, great question. So we have questions on have you made at least, so we're able to measure activity of accounts in a number of ways. The definition I'm using for inactive accounts is an active account is to have at least one deposit or withdrawal in the past year, which is a fairly low bar. And so, for example, in India, as I mentioned, we find over half of all accounts have not even had a single deposit or withdrawal in the past year. We can also, you could create finer measures of digital activity. Have you made or received electronic payment, for example, in the past year? And so we do. It's interesting. In Sub-Saharan Africa, for example, we find very low rates of inactive accounts. Most people who have a bank account are using it in our data. Whereas in other markets, India, for example, Indonesia, we do find higher rates of inactivity. I should also mention that we find also, for example, in Eastern Europe, some examples, because many adults receive wage payments, for example, into their account. And once they're no longer employed, they have an account, but now they no longer have a need for it. And so that's, again, a challenge. How can we encourage people to continue to use their accounts for savings and other purposes even after they're no longer paid directly into the account?
So I have another question here from Melanie from Jamaica. First, she wants to thank you and has mentioned that they have benefited from being included in the Global Findex, and they would like to know, how can Jamaica and other smaller jurisdictions in the Caribbean participate in the Global Findex?
I know, and I apologize. So it's really heroic to collect data from 150 countries up to 150 countries over the calendar year. And unfortunately, that doesn't include, for example, the Pacific Islands, which we would also love to have data on, and some of the smaller Caribbean islands. However, AFI, the Alliance for Financial Inclusion, World Bank, and others are supporting country-specific demand-side surveys. And happy to talk directly. We're still exploring, trying to find ways to add additional countries, cost permitting.
Well, we are actually getting many additional questions, and we only have time for a few. So I'm going to choose one that's a little bit open-ended.
Okay.
And it is, how are identity systems increasing financial inclusion?
Great question. So first, an interesting aside. And please see the data and our new notes on financial inclusion and ID in sub-Saharan Africa. We added in 2017, we worked with the World Bank ID for D group to ask a panel of questions around national ID ownership. First, simply, do you have a national ID? That gets back to some of the data I showed on the gaps, for example, between men and women in some West African countries. But then we also asked, what do you use your ID for? Do you use it to access a financial service, a mobile service, a government payment? And somewhat to our surprise, the overwhelming usage of an ID was to access a mobile service, to get a phone. I suspect that might be because in some markets it's relaxed know your customer documentation requirements for bank accounts, but not for SIMs cards, mobile phones. Regardless, that's a barrier to financial. That's first of all, that's a real barrier to financial inclusion, right? So increasingly, phones are being leveraged to provide financial services via mobile money accounts or apps, leveraging mobile agents to deliver financial services, and not having an ID to access a phone is absolutely a barrier to accessing financial inclusion. In this year's Findex, we'll be asking an additional question slightly twisted from the earlier question, specifically around is not having an ID a barrier to any of the following, including financial services. So we'll get a better handle on markets where access to the necessary identification is a barrier to financial services. I should also mention that we do have that question also. We ask all unbanked, why don't you have an account? Is documentation a reason? And we do see it important in some markets, again, especially in West Africa.
Well, I'd like to ask just one more question. This one comes from Marcella, and she asks, how about digital literacy? Is there any data point that you can measure a barrier such as this one? And maybe you can elaborate a little bit on the ability and confidence that these people have to use a mobile phone, mobile money, USSD menu, or a smartphone app.
That's really important. So first, let me mention in 2020, I was this summer traveling around the world, interviewing people we interviewed in Cote d'Ivoire, Uganda, India, Indonesia, and we tested piloting some new questions specifically around financial literacy. And we'll have some new data on how comfortable are you using a bank account yourself, using mobile money yourself and not through an agent, because it's absolutely important. It's also important to note that there's virtually no rigorous research showing the success of, for example, classroom financial literacy training. But we do know what has been more successful is, for example, text messaging information, receiving text messages anytime a transaction occurs from your account. And I think this is one of the exciting fintech innovations over the next few years will be, the increased also ability of these online and text-based services to help people manage their money better as well, and guide. We see now in the U.S. and helping them encourage savings and other better financial behavior. But no, absolutely, it's quite important. Oh, I'm sorry. I was going to say in Bangladesh, for example, there's a recent study done by the Center for Global Development, which surveyed 1,500 mothers receiving a government transfer payment in Bangladesh. And the payments had been moved from cash to electronic payments. And the vast majority of mothers, as we would hope and expect, said they greatly prefer receiving the money into an account. They have more control over how the money's spent. It's safer, etc. But there remained about 15% of mothers who said, I'm actually worse off because either I don't have my own phone or I'm not comfortable enough using it. I don't have the confidence to withdraw the money myself. And so now I'm handing the phone over to a male family member to withdraw the money. And the whole goal of these programs to target women is being lost. And so it's really important when we digitize payments to get to ensure that the recipient does have both the access and confidence to withdraw the money herself.
Unfortunately, that's all the time we have today for questions and answers. Dr. Klapper, thank you very much for taking the time to join us today and provide us with your presentation in the Q&A. I'd like to remind everyone here one last time about our upcoming conference on November 22nd, Evolution of the Global Crypto Economy, Goals, Risks, Benefits, and Challenges. Please join us if you're in New York City. I am Michael Wexler, and from New York City, I'd like to wish all of you, wherever you are in the world, a good morning, a good afternoon, or a good night, and look forward to you joining us at our next event.